thanks everyone for coming to the Rand Swiss Global Market Outlook for March. We're going to kind of run through the slides and just look at what's happened over the last month, which has been absolutely insane. As I said, we've got quite a big call today, so if we can leave questions until the end, I mean, feel free to ask them in the chat window, in the Q&A section as we go along. I will be monitoring them, so if there's something that I can cover in the presentation, I will. Otherwise, I'll try and answer them as much as I can at the end. Okay, so first of all, just before we get started, who are we? What do we do? We are basically a financial services provider. We offer a couple of different services, as many of you will know. We do online trading and private broking. The difference there really is just the level of service that we can supply to you. Obviously, if you have a bigger account, we can allocate a private dealer to you. Obviously, if not, then we've got to sorry, I'm just going to move this. If not, we've got to try and engage with you guys via webinars and kind of digital communication. Rather, we encourage you to use our technology and our apps. With the private, obviously, both of those services are self-directed, so you guys are going to trade yourself. I am going to show you a couple of different ideas today. We try and use these webinars, one, to kind of touch base with the managed portfolios, which is the next segment of the business. That's where we take control of your funds and we do all the trading for you. We build up a number of portfolios. We've got about 5 portfolios that we're running at the moment. The one that I run, that I talk about every month, is the global equity portfolio. It's got the longest track record. It's got the biggest assets under management. And it's kind of our flagship product. So I normally cover that in these monthly events. And it gives us a nice kind of touch point to discuss international affairs and all the things that have changed in the world. With the private broking, online stock broking, you guys are self-directed. I cover that as well. So I want to try and give you a couple of ideas that we might not be taking our managed portfolios, but things that can be useful to you. So I've included that as well. Structured products, these are kind of medium risk instruments. Viv Govender, kind of introduced them into the business. They're doing very well. I've got one of them for you today just to have a look at. It's closing on the 25th of March, so I thought we'd just run through some of the terms on that as well. Then we've got offshore transfers, which is kind of a subsidiary business. About 85% of our assets now sit internationally. So it's so it kind of services our client base. If you need to invest in Australia or Europe or Hong Kong or wherever it is, we can facilitate the flow of funds, which makes it a lot more seamless. If you want to move money from one jurisdiction to another, we've had clients that wanted to move money from Europe into Mauritius, and we can kind of do all of that for you now with our treasury license, which one, it saves you cost, and second, it just makes the whole process a lot smoother. So it kind of allows us to give you a little bit better service, I think. Wealth management, that's if you're looking for a little bit more, you're not sure of your income and expenses and how that all fits together with your investment strategy. Yaku, certified financial planner, he handles that, and you'll see how our different products and instruments can fit into the context of your overall portfolio. And of course, we do tax-free savings accounts, which is run by Werner. Wonderful little product. We do it for free for you. It's kind of like a pro bono work. No one likes to pay tax, and we think everyone should be maximizing these allowances, even though it's very small. It's 36,000 Rand a year that you can contribute. The compounding effect of these in a stockbroking account is absolutely enormous. So it's a hugely beneficial product to you, to clients, if managed the right way. If you're going to go and stick your tax-free savings account in one of the bank's kind of interest products, doesn't really make sense given the kind of tax dispensation around it. Stockbroking accounts will generate a lot more money with the compounding, a lot more tax saving over time. So it's the right way to do it. We manage the whole process for you. The only thing we ask to use our product is you have a secondary relationship with us, whether it's you've done an offshore transfer using one of our structures, you're in a managed portfolio, maybe you've got a little trading account with us, whatever it is, because we're doing it for free, we don't make any money on it whatsoever. We're using it just as kind of like an added benefit for our client base. Okay, why should you listen to us? Why should you listen to me? Well, we are currently an award-winning stockbroker. We've won a lot of awards over the last couple of years. Yes, we do crypto as well. So crypto is on our online trading platforms. We've got a whole lot of different crypto contracts. We also work with one of the Swiss banks which was the first European bank to actually warehouse Bitcoin. So it's basically a technologically based Swiss bank, which we can chat crypto for a long time after this as well, but we'll leave that to the end. Okay, SA is #1 stockbroker in 2019. We're currently holding the title as well. We've picked up a couple of other awards as well. Best tax-free savings account 2 years in a row, 2 years in a row, and People's Choice Award in 2021. So how do we rank? We are currently the #1 stockbroker. We've a much smaller firm than all of these guys. The guys, all the clients that have been on the journey with us, we see it that any enterprise that we're investing in or any business that you're running, you've basically got 3 avenues that you can distribute economic value. So you can either distribute it to shareholders, which is exactly what you want if you're buying into companies. If I'm going and buying Investec shares or Standard Bank shares, what do I want those businesses to do? I want them to charge as much as possible, pay their staff as little as possible, give me all the money as the shareholder. Randstad is a little bit different. It's a private business and it's owned by the people who run it. So it basically, shareholders are not really looking for money. We're trying to build a reputation. It's never paid a dividend, for example. So all that economic value gets pushed through ultimately to the client base. Our staff is also the other 2 buckets of the 3. 1 that can be pushed to shareholders. 2, it can be pushed into staff, which is staff and management. That's where you see investment banks paying these enormous bonuses and people arriving in Ferraris. Who do you think is paying for that? You, as the client, are paying for that. Or the shareholder of that business is paying for it in smaller profits. Our staff, I think, work incredibly hard for what they get paid. I'm always amazed by the kind of contribution that these guys make. They love the financial markets and get paid a lot less. And what that allows us to do is push all of our value onto our clients. So you guys get to benefit. And the beauty of it is the more clients we get, the more we can expand and do better and better things for you guys. So it's that's why we love our online trading business and our private broking business. Why do we want you guys? I mean, we cut your costs to almost nothing, but because we bulk up all your flow, when we go to the investment banks to get the products, we can get better and better prices using everyone's collateral together. So the idea is put everyone's cash together and let's go and do something really, really special. That's Randstad in a nutshell. If you didn't know us, if you do know us and you're used to the presentation, I always take the first couple of minutes just to run through new people what we do. And I'm going to mix it up a little bit today. So the agenda for today, I'm going to go through the big headlines of the month, as I normally do. We'll do economic indicators and then commodities, because I think the headlines this month are going to affect economic indicators and commodities. We'll quickly have a look at the currencies, and then we're going to have a look at equity markets and just address the portfolio. And specifically, I've had a lot of questions about Alibaba and what's happening in China. So we're going to have a little bit of a deeper look at Alibaba today as well, and just the investment case behind China. But looking at what we talked about last month it was clear that every headline, every financial newspaper, it was all about inflation. It was something that we've been talking about for 6-7 months. It started with the idea that the inflation was going to be transitory. We said, come on, guys, transitory. We do our own dot plot in our investment committee meetings. We said, this is not going to be the case. We think inflation is going to run persistently higher than people are expecting for a longer period of time. That's starting to play into the market now. It was last month. And you're seeing, US inflation, at rates that we haven't seen since 1982, 40-year highs on inflation. Global supply chains were the reason. But of course, what has happened in the last month, something that's going to make it's a game changer. Everything is going to change in terms of inflation, or at least that's what markets are starting to price, and that's what markets are thinking. So since we last spoke, we had Russia invade Ukraine. And I mean, it has been absolutely astounding to watch. I mean, I'm sure you guys have been watching kind of the mainstream news, watching the CNNs and the BBCs and the Al Jazeeras and everyone kind of covering this just absolutely extraordinary war. And it has been just crazy. Ukraine, missiles hit Kiev. I mean, these kind of things. I don't know if you guys. I mean, I've been obviously following it very, very closely, just as our clients react to the headlines. They want to speak to us from a broking point of view, just so that you guys understand what it's like in a business like this. One, we've got insane market volatility, and we're going to look at it under the commodity markets. Oil prices shooting up $20, falling $20. And it's kind of like we've got a business where we kind of, we're used to the intensity of the work, if you want to put it that way. But suddenly, when you've got a couple of thousand clients that are watching what's going on in the Ukraine, the volume of work. So I suppose the one thing I want to say, just from a business point of view, if you guys are clients and you haven't, you feel like we need to be more there for you, trust me, we want to be more there for you. But the volume of work that's picked up now is it's just absolutely crazy on the desk at the moment, which is, well, you'll see bags under my eyes, and the guys are struggling a little bit. Now we are expanding as always, so you'll see a couple of new faces, and I'm going to kind of take you through some of the new research guys as well. If you guys know Anthony Clark, you'll get a mailer from, kind of introducing him. We've contracted him as an external analyst. I'm so excited about the research that we can deliver to you guys from him. He's the top rated small and mid-cap analyst in South Africa. It's a sector that no one covers. Institutions don't cover it, because if you're Coronation or Allen Gray, they can't buy into these companies. They're just too small. It's one of the reasons that there's just such high misprice in the sector. We've got him. I'm going to send out a mailer we've got to limit his research to a very small number of clients, unfortunately, but we'll send out a mailer kind of with invites to the clients that have it. We're also launching a new trading service, so it's a lot going on in the background. But with this going on as well, it's been absolutely wild. It's been absolutely wild. Plus tax year end. It's been a couple of very, very crazy weeks on the desk. If you guys remember, I mean, the one day we woke up, we thought things were maybe settling down. The whole idea was that the war might be very short and very sharp. We had kind of the saber rattling around nuclear weapons, and suddenly we had Europe's largest nuclear power plant on fire. People reporting that they were lobbing grenades at a nuclear power plant. I mean, it is absolutely insane. We were sitting in risk meetings and investment committee meetings, literally asking ourselves seriously the question whether the world could potentially go into a nuclear war. I mean, in 20 years in the markets, I've never had to have that kind of discussion before. So it's been pretty insane. What are we seeing react? Germany's buying US-made F-50, at least F-35 fighters. Who supplies those? Lockheed Martin. Who sits in our portfolio? Lockheed Martin. So defense spending starting to increase. We've seen Russia being banned from the SWIFT network. We've seen Russia come back against that. We've seen an increase in cyber attacks. I mean, although originally when the war first started, people were saying, why isn't Russia, who has a high capacity for cyber attacks, not more prevalent in that sphere with this invasion? Why didn't they shut down government agencies in Ukraine before the invasion? It looked like Microsoft actually stepped in and found pieces of code and managed to suppress that. So while we've got a hot war on the ground, which is, I mean, the human cost is just incredible. I mean, the stories that you're seeing out of Ukraine are like, it's depressing to watch. It's difficult to see this. You've got a hot war there. You've got an economic war that is absolutely raging in terms of sanctions and seizing of mega yachts and the oligarchs. Businesses across the globe just refusing not just to work within Russia, but refusing to work with Russian people, which is astounding to me. I mean, I'm a big advocate of obviously property rights, and yes, I know oligarchs have ties to the Russian economy and a lot of the businesses, especially, and we can talk about a little bit with China as well. A lot of these kind of strongman economies, they're not capitalist economies, so their business ties with the West are not just profit driven. There's a strategic advantage to that as well. So yes, there might be a case to seize private property, but even that, Western democracies just seizing private property, the world has gone crazy. Economic war raging, tech and cyber war raging. The battle is being fought on so many more fronts than we've seen in traditional wars as well. Social media, the idea that social media feeds within Ukraine are having videos delivered to them on how to make Molotov cocktails, and Elon Musk delivering Starlink systems to Ukraine. And it is absolutely insane what we've had to witness. Now, what we've got to try and understand here is how do we respond to this as investors? So I'm kind of giving you a little bit about how I'm responding personally to it, just from an emotional point of view. But I mean, let's look at how should we respond to this as investors. Now, the first thing, CNN runs a lovely little thing on their website. They've done it for years, and if you're interested in it, you just type fear and greed index into Google. Go and Google it, and it gives you how they calculate it. It's a combination of VIX, which is the volatility index. I always have a look at the VIX specifically in these presentations, but it's got 7 or 8 indicators that form a composite and give you the fear and greed index to try and give you a gauge of where sentiment is sitting at the moment in financial markets. So I've put it up for you there. I mean, fear gauge is sitting at 18. Okay, so it was a little bit more extreme a week ago. When you have power stations on fire, people are pretty scared. Nuclear power stations, that is. When you have, Putin saying that he's going to attack, he's going to see supply deliveries to Ukraine as military targets, even if they're from NATO. That is terrifying. That is absolutely terrifying. But we went from extreme, we are sitting, previous close extreme fear, 1 week ago extreme fear, 1 month ago extreme fear. So a year ago, we were in the greed world. So I've just also given you they've got a nice chart over time as well. So you can see we kind of not quite at those pandemic lows on the index, but the market is very, very afraid at the moment. And we're feeling that in terms of equities. Now, what does that mean for most people? So really it means buy. Like the idea for me is buy when others are fearful. It's the old Warren Buffett philosophy. Now, if you're trading, it's a little bit different because traders, you've got to, you have to ride momentum. And I'll tell you a story about that in a second. But let's just run through what should you be doing on your portfolio at the moment. The most important thing before, the key one that everyone is going to tell you is don't panic sell, this too shall pass. Yes. You should know that, and I feel like our client base knows that. The calls that we've been taking and the kind of interactions that we've been having with our client base, our clients are not worried about what's happening in the sell-off, and that is incredibly important. For me, as as one of the senior guys at Rand Swiss, that means that our products are being sold correctly to clients, which means that if you're in an equity portfolio, you as a client should realize it's long-term. Short-term volatility like this doesn't make our client base panic, which means that we're explaining our products accurately to you, which is a great thing. But before the don't panic sell, because you shouldn't panic sell, this is an opportunity for me, if you're a longer-term investor, to be buying. The most important thing to understand is what type of investor are you and how are you investing? So if you're an opportunistic trader, and most of the guys that we're speaking to at the moment are looking for the opportunities in chaos, that the saying is never waste a good crisis. That seems to be what our client base is doing at the moment. They want to deploy new capital. They want to get in. They want to shift into sectors that are going to benefit from this kind of action. So yes, buy when others are fearful, but have a strategy again. It's about, if you're a momentum trader, trade the momentum. And I mean, I had one of our bigger clients phone us the other day. Oil was at $100 a barrel. The Ukraine conflict had just started, and he was, wanted to put on an oil trade in size. And we were buying futures overseas, which you can do through our platform. Buying kind of like we were just discussing the difference between going into the nears and the fars. We kind of decided the nears because the liquidity was going to be better. The time horizon on the trade was pretty short. I kind of looked at it and said, listen, like, I'm not going to say buy, on those kind of very short-term movements, we don't normally give advice to clients. We're there to facilitate and understand the contracts more than make a call on a 1 week movement. That's for our self-directed base to decide. We'll always give our opinion if asked. I kind of looked at it and said, I don't know, oil at $100 a barrel, the time to really be speculating in oil for me was a couple of years ago when we were at $30 a barrel, because I don't know where the top and the bottom of this movement is. It's like, Gary, I'm going ahead anyway. Said, no problem. I mean, we were buying at $100 a barrel. I thought, this is crazy. 2 days later, we were at 135 a barrel, and he was taking profits. I mean, in 2 days, it was incredible how much cash he made, but two, just that kind of volatility. Oil now almost back at $100 a barrel. The volatility just scary. Very nice for traders. But what I would say, wider stop losses than usual. Just again, have a strategy and stick to it. Follow wider stop losses, but still pay attention to your stop losses. The market, that kind of volatility, you can make a lot of money short-term trading, but realize you're not an investor. You need to kind of play the sentiment and the daily swings, and the market is very headline driven at the moment. So just be careful. If you're in a geared position going, but the fundamentals on this company are just so good, you're going to get hammered. So I think just try and feel the pulse of the market if you're a very short-term opportunistic trader. If you're longer term but want to use this as an opportunistic deployment, I believe buy when others are fearful. If you are a long-term investor and you're kind of looking at your portfolio statement, you're going, oh, ouch, I'm down 10% or whatever. I mean, just understand the reason that equity delivers so much to clients and so much to investors over a long period of time is that you pay for that higher return by being able to ride out volatility. That's why you get the higher return. Which kind of, I said, so what do you do if you're a long-term investor in this? If you're a long-term investor and you're already deployed into the market, the worst thing you can do now is sell. You want to just ride through that volatility. That's exactly the right thing. You could even use it, and I've put it there, to reposition for a CGT benefit. Now, if you've chatted to one of our wealth guys, or you've got your structuring correct and you're working through an offshore trust, or you've got a vehicle that is limiting your capital gains tax, then this doesn't really apply to you. But if you're a private investor that's got cash in your own name that you've taken either overseas or you're sitting on locally, you can use this kind of sell-off to almost defer a little bit of tax. You can kind of lock in a level. A lot of guys would used to do it with, let's say, I'm trying to think of one that I mean, you can't really do like a Mondi, M&T, but you could, you do it with the holding companies like PSG. You might go, out of your PSG and buy Capitec and kind of the underlying PSG companies, for example. It's still like borderline, and that's why I've put in there, be careful of the bed and breakfasting rule if you are going to use this sell-off to kind of reposition yourself in terms of tax. Bed and breakfasting rule is that literally if you sell when you go to bed and you rebuy the same stock at breakfast. So you sell one day, you buy the day afterwards to kind of lock in the tax you want and then get back into the position. In South Africa, if you're going to buy and sell the same security, the rule is 45 days. And then you can claim the tax loss. There's no penalty if you do it, and you kind of think you're going to get the CGT, but you just won't. If you're reporting your taxes correctly, essentially what's going to happen is that they're going to see you as not having bought or sold the stock. But if you are looking at repositioning and you've suddenly been hammered on something like Naspers, but for a long time you've wanted to go into China, you like Tencent, but you want to use this opportunity to sell down some Naspers in South Africa and deploy directly into Alibaba and Baidu and JD.com, this might be the time to do it. It's different assets. The bed and breakfasting rule won't apply. If you're kind of confused about it, come chat to us on the desk. We can kind of advise on that if you need. And then finally, also, is your tactical asset allocation correct? Jeez, I've got to move on here. Okay, is your tactical asset allocation correct? If so, why are you even worried? You probably shouldn't be worried. If you're sitting in, if you're looking at your investments as a whole and you're going through a bit of a sell-off now, you should never be withdrawing from your equity account. An equity account is 5 years plus. You should have shifted money into your first and second bucket, as the guys talk about, into your kind of fixed income products and your medium risk structures. If you've done that, you're absolutely golden. You're not even worrying about this. You've got 5 to 7 years worth of capital that you can access that is totally protected in this market. Do not panic, sell the shit fast, and also just try not to get caught up in the hype as well. So everyone was, and that's what I'm going to talk about in economic indicators. When you have these big emotive headlines like we have at the moment, it's very easy to go, oh, oil is $140 a barrel. That means inflation is going to go berserk forever, and everything is, like there's a lot of emotion in markets as well. And when it's headline driven like this, you've got to try and look through it, base it on the numbers, base it on a strategy. So don't get caught up in the hype. But then again, if you're a short-term trader and you're kind of trading the hype, that's part of your strategy. So it depends on who you are, which is the most important thing. Understand who you are when you're investing in trading. Okay, so what was Russia thinking, man? What were they thinking when they did this? So it seems like the goal was a blitzkrieg, but it's failed. So, I mean, Russian soldiers went into Ukraine with only 2 days worth of food. The idea was that there was going to be a very quick transition of power. That didn't happen. They wanted to install a pro-Russian government very, very quickly and pull out. Obviously, that didn't work. They didn't expect the Ukrainians to be as well supplied. They didn't expect, I think, the degree of the Western sanctions and the Western support that Ukraine has been getting. And this has put Russia in an incredibly difficult position. Instead of having the whole of Ukraine, this is, okay, so this is a day or two older, about 3 days old, but you can kind of see what they were trying to do here is obviously connect that land bridge so that they can have all of this. And I mean, they obviously pushing down the supply chain. I mean, I don't want to go through the war in too much detail. I just want to kind of look at more the results of it. But that's kind of where we're sitting more or less at the moment. And the way that we like to think about things like this, when you have a big shock to the system and you're trying to work out what this means, is we go back to scenario planning, which is always a nice way of looking at markets and looking at things that can happen. So we've kind of put some probabilities on this, and this isn't exhaustive. So there are other alternatives. We see other alternatives is probably between 5 and 15%, but these are just 4 kind of probable outcomes that 4 things that might happen. So the first thing which we're putting on a 5% probability is a serious escalation. So I've got nuclear strike there, but it's kind of we actually put in actual nuclear war at less than 1%. You don't bet on the end of the world normally, but in escalation. So the conflict escalates outside Ukraine. What does that mean? Maybe Russia attacks NATO weapon supplies. Now NATO is drawn into the conflict. That severely escalates the scale of the conflict. Putin doesn't back down from this, which is in line with his character. Like I said, the war may turn nuclear, which is a total disaster for Russia. The whole world, any nuclear weapons get used, the whole world turns against that country instantly. And it's almost a game over from that point on. There's no, it would have to be total insanity for that to happen. I wouldn't discount total insanity. History tells us that humans aren't the most sane creatures, but we're putting it at less than 1%, but an escalation of about 5%. What does this mean? Military spending around the world is going to increase significantly over the long term and in the short term. The escalation should unite the West, but looking at the kind of balance of power, even with China and supporting Russia, which we don't think is viable, really, an escalation ends with Russia ultimately and utterly defeated, and the defeat leads to heavy concessions from Russia. About a 5% probability that scenario plays out. Another potential end to the conflict, Putin is overthrown. So Western sanctions absolutely kill the Russian economy. Riots and protests, which are currently being suppressed, cannot be suppressed any further. Putin has lost face because of a lost war. And he, at the same time, I have just finished a book, Putinomics. You've got to become an expert in Russia when these things happen very quickly. So looked at the whole history of economics in Russia under Putin. One of the key mechanisms that Putin uses to maintain power is the pension system in Russia. He's always focused, even when they took Crimea, they immediately increased pensions. They look after kind of the retirement. They spend very little on education and a lot on the pension system to kind of maintain an equitable worker power. Sanctions bite, pension system collapses. Anti-war forces gather and Putin loses total control. He can't prop up the current network of patronage. That falls either through civil strife, political mutiny, coup d'etat, some method of power transfer happens. A new leader steps in and foreign policy takes a different tack. They back down, Russia backs down from the West, they end the war. But if that happens, you see them start to fade as a global power. The idea of a strong military Russia is less and less relevant, and they kind of get pushed to the backstage. About 10% chance that's happening. I do think that Putin has a fairly tight grip on power in Russia. Okay, so then we'll go to let me go to the 35%. The other option is that Russia actually wins in the Ukraine. As we kind of discuss on the desk, there's never been a time in history where Russia has stopped because of the loss of Russian lives. You look at it, World War II, for example, Russia spent a lot more lives than the Nazis, and they ultimately prevailed. I mean, the deaths of Russians versus Germans was absolutely incredible. Russian debts far, far higher didn't stop them from winning. So let's say Russia seizes Ukraine at a much higher cost than it originally thought. Succeeds in this desperate gamble I've put. Ukraine becomes a total political nightmare. Either Zelensky, comedian, actor, turned hero of the struggle, sets up a government in exile, or Zelensky is killed, and someone else steps in, and there's this government in exile, and the battle now starts to rage longer term. Because Russia hasn't won the hearts and minds of the people, of the Ukrainian people, as potentially the Kremlin was expecting. There's total economic collapse unless there's significant support from China, and a new Iron Curtain falls on the world. Global trade is rerouted. China becomes more influential, with Russia almost becoming a quasi-vassal state, because they trade with Russia instead. That kind of keeps Russia going. And you see Africa, South America, and India maybe start to align with the kind of more authoritarian powers. I think South Africa, India is kind of moving that way. Brazil, if you look at the BRICS nations, has gone the other way. South Africa, we're kind of flip-flopping at the moment, but as a democracy, I kind of feel we're going to follow the democratic segment if the world does bifurcate in this way. But there's a clear polarization between democracies and authoritarian states, and that becomes quite pronounced. And we'll see that, again, on the economic front, it will happen in terms of Chinese payment systems replacing Visa and MasterCard, or at least being run in parallel to Visa and MasterCard in certain countries, and kind of a bifurcation happening if Russia does seize the Ukraine. We're putting at about a 35% chance that could happen. And then, of course, the one that is more likely, and the one that we believe you should be essentially betting on, is peace talks eventually succeed. This is the logical choice for Russia, but Putin is unlikely to accept peace without significant concessions from the Ukraine. The problem is, if you can't win it on the battlefield, it's difficult to win it at the negotiating table. So you probably need to see a more dominant Russia in the conflict currently before those peace talks will succeed. Then Russia will obviously take maybe segments of the Ukraine, maybe the Donbas region, that might go to them. But kind of a tentative peace, but Ukraine survives as a country. Russia again becomes more reliant on China and non-Western networks, because that even with peace, it'll still simmer in the background. NATO is strengthened. You probably see Switzerland, Sweden abandon neutrality. Germany and France, defense spending rises permanently because of what we've seen, and the world also gets split. A bifurcation, maybe not as focused as if Russia wins outright. But China becomes more dominant than ever, with Russia still falling under China's sway. China really a big beneficiary, I think, of this. And then new challenges arise, new opportunities comes, and the whole misadventure is kind of consigned to history books, but it does fundamentally change the way that the world operates. So that's kind of our thing. Now, there are a couple other, we've got kind of parallels between Afghanistan, Russia and Afghanistan, US and Afghanistan. As other scenarios that can come out, US and Vietnam, that kind of situation is being established. But I think those are the ones that we're kind of thinking about in a realistic way, with peace talks succeeding after, more conflict, but not necessarily an escalation, and a slightly more dominant Russia in the conflict, and then peace talks with Ukraine surviving. That's probably like our highest probability. So how, as a self-directed client, this is not something that we're doing within portfolios, but it's something that Viv decided he wanted to put together a thematic basket for everyone. It's not one that, you can come and tell us, Gary, put me into the thematic basket and we'll just buy it for you. It's not an actively managed product or anything like that. But Viv said, let me go, I'm going to put together basically 10 stocks you can buy to take advantage of what looks like a fairly good bet. So, peace talks succeed, defense spending goes up. Escalation, defense spending goes up. Putin's overthrown, maybe it doesn't go up, but probably defense spending goes up. Russia wins, defense spending goes up. It doesn't matter what's happening, defense spending is going up, and it's probably going to go up for a long time. So this gives you a whole lot of defense and you kind of defense-related and defense-adjacent companies. The one comment that I had for is like we should be looking at more cybersecurity companies as well, things like CrowdStrike and Avast maybe, but cybersecurity I think is going to do as well. I would have also put something like Ørsted in there, which is alternative energy company in Europe, because obviously with energy in Europe, Russia is no longer going to be the gas station of Europe, that's for sure. I think Europe is going to accelerate renewables. Ørsted, a lovely renewable company, I would have put that in. It doesn't fit in the defense basket though. But there's a whole lot of stocks. This presentation will be circulated afterwards. Grab a screenshot or go and catch it on YouTube afterwards. And then go follow us on YouTube as well. We're trying to build up a YouTube channel. It's still early days, but just as a little bit of fun. And it's a nice place to kind of put all our content together. Okay, Lockheed Martin, we already own in portfolios. BAE Systems, we already own in portfolios. But the rest of them, nice little defense basket, shortlist if you're looking for some stocks. I haven't put rankings on them or anything, but it's just the stocks that Viv likes. And then, I said I'd talk about while we're talking about Viv's ideas. Viv's got a structure that's closing soon. And this is, again, if it goes back to like, how do you react to the Russia-Ukraine war? If you've got your tactical asset allocation right, you should have structured products in your portfolio, and you shouldn't even be worried about these kind of things. But one thing that it does give you is it gives you an opportunity to get into new medium risk products if you do need a level of capital protection. If you're concerned that we're going to go into a escalation or something, the world to get really, really bad, putting capital protection on portfolios is often not a bad idea, especially if you're linking to index upside. So what this portfolio does is it links you to the Selective Sustainable Development Goals Index. It's an okay index. It's got some quite alternative companies inside it. It's not the typical Microsoft, Facebook, Amazon kind of basket. It's all very, very ESG-led companies. I think that is still a massive theme that is going to play out. And while the index hasn't been an S&P 500, for example, the beauty of this product is that you're going to get at least 4 times that index as a return in Rand terms. So which is quite cool. So if the index goes up, so that's scenario 1 and 2 below. If the index rises 10%, you get 40%. If the index rises 30%, you get 120% of your return. You put 100 grand in, you're going to pull out on a 30% rise of that index, you're going to pull out 220,000 rand. If you obviously if you put in 100 grand and the index goes up only 10%, you'll at least outperform the index. Like that's always going to happen. So interesting product, definitely. I think the reason that we like it so much as well at the moment is that the last time we ran this product, it was advertised at 4 times, but because of kind of the mechanics of the product, we actually got a 7 times multiplier for clients, which is absolutely awesome. There's 100% downside protection as well. So the market falls 30% over that period, or that index at least falls 30% over that period, and indices these days are fairly correlated. You'll get all your money back. If it falls 50% over 5 years, you'll get all your money back. So if we are in for a protracted bear market for 5 years, this gives you kind of a little bit of optionality. Yeah, you're not going to lose money on the index, but you might get 4 times upside or maybe more. So we like it. The kind of one of the drawbacks, okay, not a drawback. It depends again on you as a client. It's put inside an endowment vehicle, so the liquidity is basically zero. There's no getting out of this. This is a lockup for 5 years, and it's a proper lockup. The benefit that you're getting for that is that it's going to give you a 12% CGT rate. The tax is taken within the product, and you then don't have to worry about paying tax on your return. Obviously, the downside protection is also guaranteed by an A-rated bank. So we also take no markup on it. All the fees are included inside the structure. So you will not get this product cheaper anywhere else. You can go Google which product it is. You'll find the product house, I'm sure, pretty easily. They're probably going to charge you more than we'll charge you anyway, because we're distributing at quite a high level. So that's a product, nice little product if you are looking for something with capital protection. I also just think about it. Markets are lower. You're locking into an index that you get 4 times upside on. If markets rebound over 5 years, which they probably will, you're going to do spectacularly well. So we like it. Investec also released three new structures that we'll be chatting to in a little bit. I'm going to probably get Investec to come and present to you guys directly through one of the webinars, and they'll take you through some of the mechanics. We've priced one of them at our Swiss bank, and we can actually get you an A-rated bank at a slightly higher coupon. But let's see. I mean, markets are dynamic. They've given themselves a lot of fat in the product because those products are a little bit longer term. They'll be expiring, I think, well, at least the closing dates will be April and May. So there's still quite a bit of time to get into those products. This one, if you want it, 24th of March, call us, speak to Verve, he'll get you in. It's one paper, do a transfer, one form, do a transfer, and you're into the product. So nice and simple. Okay, so let's look at economic indicators. So how is all this craziness going to affect the economy? So we have already been positioning for much, much higher inflation. Inflation, we said, like I said, we said that this isn't transitory. Once inflation gets in the system and people start asking for higher wages, then they have more spending power, then they want to buy more, then everything, it just becomes a cycle and it gets entrenched very, very quickly. And we haven't had proper inflation for so long, and central banks have been very kind of casual about inflation. So we've always thought it's going up. So guess what? It is going up as market people. I mean, listen, Fed people and central bankers and market people have very different perspectives. And, you know, like I think they wanted to leave the punch bowl in. I get the sense they left it in a little bit too long. Now with the Ukrainian conflict and the disruptions that we're going to see to things like potash, and which is incredibly important in the nitrogen cycle, which is going to push up soft commodity prices, which is going to do all sorts of things. Inflation is going to get worse. Now we had US inflation came in at 7.9%. You know what? The real interest rate, the Fed's fund rate is at 0.25%. We are going to have the conclusion of the FOMC meeting this evening. So we are expecting tonight they should hike interest rates in the US by 25 basis points, 0.25%. Interest rates will go up in the US, supposedly. They might go as high as 50 basis points. I think with the Ukrainian conflict, they might be a little bit nervous of how markets are going to respond to a 50 basis point hike. We kind of think 25 basis points is where it's going to be. But you will see that curve on the bottom right-hand corner just pop up a little bit by 25 basis points. Well, now you're getting 0.5% federal funds rate with inflation at 7.9%. Deeply negative real yields on US dollars. You cannot sit in cash. You can't sit in cash in this environment. If you are sitting on cash, it is going to be eroded before you even know it. You're going to go, oh look, I had a couple of $100,000, and now I can buy a Coca-Cola. Maybe not that bad, but it's going to get bad out there. So you have to deploy into physical things. Sectors that are good, if you're concerned, consumer staples. I talked a little bit about defense spending. Banking sector is still very, very cheap. We'll give you a nice little inflation hedge there as well, even if we go into recession. Commodity stocks have gone berserk, but I'm going to look at commodities specifically. But stocks are an inflation hedge. Hyperinflation in Zimbabwe. What is the best performing stock market in the world in dollar terms? Zimbabwean Stock Exchange. So inflation stocks are an inflation hedge. You could look at gold with interest rates going up. Gold spiked above $2,000 an ounce, went all the way up to about $2,070 an ounce. Has come back significantly since then. The concern there is that if interest rates do start going up quickly, gold doesn't pay you an interest rate. That said, gold is also an inflation hedge. It's also a hedge against war and panic and all sorts of things. So I always, like I said, I've always preferred physical gold because, I don't really like buying gold ETFs and that kind of thing because I don't really believe it. It's a proper asset class inside a portfolio. It's an alternative asset that you kind of have a little bit of on the side for when the apocalypse comes, and it's fun to own. But it's not, for me, it's not a serious investment asset class, but it is an inflation hedge. Property linked companies, property REITs also should do well if we see inflation really starting to pick up. Again, it depends on how fast the interest rate hiking cycle is, because we've got to kind of look at the expectations around real rates. Obviously, very quick interest rate increases makes bonds more expensive. That puts pressure on property. But if the interest rates are lagging behind where the inflation is going, then very, very good to own stocks. And property stocks will do well then as well. So I kind of like that idea. Unemployment in the US coming down quickly, growth in the US picking up. Let's look at the South African economy quickly. We've started our interest rate hiking cycle. You can see we're down there. You know, unemployment rates, we had that kind of anomaly number, but unemployment, we haven't got new numbers since last month, but unemployment's still terrible in South Africa. Let's face it, it's not going to get any easier as inflation starts to creep up and things get more expensive. Yeah, civil unrest, we saw it last year. I think we're going to see it again. South Africa is a difficult place, even if our stock market is awesome, because that is just doing so well. And we'll look at that in a bit. Inflation in South Africa, we're still within the target band. Remember, all of these inflation numbers are pre-Ukraine war. So we haven't seen the effects of Ukraine playing into inflation numbers. We got our GDP growth rate out. I had questions around here. People, oh, I don't believe South Africa's economy is growing that much. We were growing off a very, very low base. So that's a quarter-on-quarter number. I think we grew almost at 5%, but it was off a very, very low base. It's, as I was explaining, if you've got 100%, if you lose 50% of your trading account, you need 100% to get back up. That's how it works. So we're still not at pre-pandemic levels of absolute gross domestic product. So South Africa growth still fairly lackluster. We've all been through load shedding recently. Difficult place to invest, South Africa, but also really exciting. And at least we don't have the specter of nuclear war hanging over us. Kind of look at Europe and think, hey, I'm kind of happy to be sitting down here on the tip of Africa. But yeah, so commodity prices. So, I was saying, like, if we were just looking at monthly data and not watching the news, you might think that we didn't have a busy week, busy month. But have a look at this. So this, I'll look at each of these charts, but this is basically a snapshot of what we're going to look at. Key commodities. So this is basically a composite of the Bloomberg and Reuters indices, just flying up since our last meeting about in early February. We've seen a massive spike and a subsequent pullback in commodity prices, volatility off the charts. Oil performance, these are the different oil contracts. We'll look at it, same. I mean, we saw oil almost at $140 a barrel. Volatility, insane. I'm going to zoom out on these so that you can get a better feel for how abnormal this is in the context of a portfolio. The power complex, which is very focused on European power as well. Obviously, we've had big spikes in certain contracts there with the idea of Nord Stream going offline, and just how is Europe even going to heat itself when it comes to winter with this Russian conflict, and are we going to sanction the US oil, at least the Russian oil? Are we not going to sanction the Russian oil? Very, very difficult. Soft's actually quite benign at the moment, but that is coming. I do believe that is coming. So I've just put a little blue square since we last talked so that you can just see what has actually happened in the last month. So this is the Bloomberg Commodity Complex and the Refinitiv Core Commodity Index. They'll track each other more or less. So just put two on so that you can see what they're doing. But I mean, major spike, major collapse, big volatility in commodities in general. So if we look at the oil markets, what happened? Brent crude oil, which is LCOC1, which is the orange one, big spikes. Europe low sulfur gas oil, which is the blue one. That's the big. I mean, look at that. It more than doubled in the last month and has collapsed again as well. I mean, again, it comes to massive volatility. I didn't put the long-term oil chart on for you, which I was sad about. I just wanted to actually show you that as well. So we've been fielding a lot of questions from investors like, can I buy oil now? If you're trading it, great, but a lot of guys are going, is now a good time for me to go and buy some oil and just hold it? And oil is not a long-term thing. Okay, it does look like it's gone up nicely over time. But if you go back, if you bought oil in the 70s and just held a barrel of oil, all you've done is pay storage cost and carry cost on your futures and been rolling it. You've just lost all your money, basically. Like, it's not a long-term, oil as a commodity is not a long-term investment. It's not something that you can invest like that. You can go and buy something like USO, which is an ETF that kind of rolls all the futures and gets like a discount because of its size, and there's some efficiency to its economy of scale, but you don't want to invest long-term in a commodity. That's not what commodities are for. The reason we look at commodities is so that we can understand input prices to stocks, which are beautiful little instruments that have management teams that go out every day to make you money and make you richer and richer and pay you dividends. And that's way better than owning a commodity and just holding it longer term. So if we look at that, oil absolutely berserk. Like I said, the soft performance of the last month actually hasn't been bad. So we've seen that, the Intercontinental Exchange US coffee futures, the KCC2, was spiky. I mean, coffee, I was like, oh, are we going to afford coffee anymore? Inflation everywhere. But we looked at it last month in relation to Starbucks and Starbucks' hedging policy. But you can see coffee futures actually coming down aggressively at the moment, which is one of the softs that was in a little bit of trouble. But you can see not the same kind of moves that we've seen in sugar and cocoa and orange juice, not feeding into the softs the same way as we saw into the oil prices. They're not reacting quite as aggressively. But yeah, it's still, sorry, the JRU, that's rubber. I still haven't updated that. So JRU's rubber, which is the blue one. Soft's not feeling the inflation, but you kind of get the sense that they will feel the inflation as things play out. The power complex, so as I said, this is the power complex, and you can see the orange one, which is NGL NMC1, which is the UK natural gas prices. Natural gas in the UK, I mean, the energy bills, if you speak to clients in the UK or people, that family or anyone living in Europe, as many of you know, my sister lives in Denmark, and she said she looks at a power bill, her utilities bill, and she says it's absolutely insane. They're talking about 10 times the price of energy. But again, you're seeing that subsiding quite quickly as well. The volatility is quite high. So, when oil was at $130 a barrel, people were talking, if it's persistent at this level, we're going to talk about like 35 Rand petrol prices in South Africa, because we're obviously an oil importer. But again, it's volatility, it's a moderation, it makes it difficult to plan. Unfortunately, Sasol announced that they've been hedging, well below $100 a barrel. So they weren't really participating in the upside on the oil price spike. And I think people got a little annoyed with the company of that based on that. But at the same time, hindsight is 2020. You don't know until it's over if you did well. And let's see what happens with OPEC and with the ability to bring more oil on stream. Are US shale guys going to get back into the market? I mean, OPEC plus meeting, at least OPEC meeting this, and drop the plus now. The OPEC meeting plus was Russia. OPEC meeting this month, they said that they're going to continue with the 400,000 barrels per day in April, which is in line with expectations for the market, but they are struggling to bring on new supply. We talked about it when we did our energy meeting. There just hasn't been enough new oil wells sunk. There's going to be if growth and transport and the global economy really gets back on its feet properly, we don't have enough oil. We need either a very, very quick transition into alternative energy, which I think humans are working on as fast as they can. But you do feel that there's a bit of a lag, and that's why we've seen this big spike in oil prices. Now, how long does that last? Will they be able to bring new oil on stream? Will we move to alternatives faster? The higher the oil price, the more pressure there is to move to alternatives, the more funding goes into alternatives. It's going to be interesting to see how it plays out. But I still feel 100. I think we're going to see oil. We saw Bank of America and Goldman Sachs reports where they had oil at almost $200 a barrel. I think personally that's too much. With Russia, I didn't expect a Russia-Ukraine conflict at this scale. I don't think anyone did. I was saying kind of $80 a barrel is where OPEC wants the oil price. They don't want it too high. And they will bring on new production to keep it there if they forecast that consumption will be a lot higher. But yeah, obviously this is a supply shock, but I do feel like it will work out of the system. I think maybe trade the oil, but not investing heavily in oil at this stage. I don't think it's the right move. Okay, let's look at currency markets quickly. Okay, so these are the forecasts from the big banks on the currency. I've done the technicals on a couple of different currency pairs, but we've also got obviously all the big banks and brokers, because they tell us what they think, which is great because they have giant client bases who these forecasts feed into. They finance transactions and they use these forecasts as the basis for their view, and we know them, and that's just cool. It also gives us a sense of, like, I always like to look at the range that we're looking at as well. So if you are looking at moving currency, and like I said, it's a subsidiary product for us, we have to make currency calls on almost a daily basis, which is why this is in here. We have the current price about 15 Rand 09 to the dollar. The lowest now, Goldman Sachs is no longer the most bullish bank on our currency. That now goes to Standard Chartered, which actually didn't move the estimate. It's still sitting at 1440. Goldman Sachs has shifted theirs up to 1450. Remember, they were at 1280 a couple of months ago. So Goldman Sachs getting a little bit more bearish on the South African economy. Is still optimistic at 1490, I think, 1450 at least, I think. Deutsche Bank coming in 1543. JP Morgan quite bearish, up at 1667. Danske Bank, the most bearish poll. This is a Reuters, at least a Refinitiv poll. So Danske Bank, the most bearish, it's 17 Rand to the dollar as the outside level. But I mean, we're sitting at 1509. The most bullish bank is at 1440. I think, you know, you move cash out. I mean, I would say 15, if you can get 1501, 1502, 1503, the time to move. It's the time to move currency. We've seen a big windfall on our local currency thanks to firmer commodity prices. SA is a key commodity exporter. We've got a trade surplus and a budget surplus. I mean, we're making a fortune of this commodity disruption. The problem is commodities are very cyclical. I have said repeatedly that I think there's an underinvestment in commodities at the moment. I think, you know, our commodity companies were burnt a while ago, and we've seen them paying out dividends rather than sinking new shafts and building new projects. But I don't know, commodity prices are still very, very volatile. So I don't know. I mean, I had a big chat with Lindsay Williams the other day about whether or not we would be buying commodity companies at this stage. And I think they're still in the portfolio, but they're not that kind of like screaming buy that they were. So yeah, I think just be careful. You know, markets can change very, very quickly. And remember, markets are a mechanism to price everyone's expectations of what's going to happen. So if people all think that you know, there's been an underinvestment in the commodity complex, that's why they're pricing it the way that they are at the moment. So, you know, a little bit of an indication that they're going to start sinking shafts, and I think you could see commodity prices coming down pretty quickly, put the stocks under pressure as well, put our local currency under pressure. Can easily be the reversal. Looking at the pound, so you're going to see a very similar pattern across franc, pound, and euro. We were kind of in this little hovering up channel. We've kind of pulled back to that horizontal support that goes back to kind of September 2021. It does seem to be kicking off 1950 to the pound. The next level below that is probably 19, that old level that we saw around June, July 2021. You would probably expect a retest of, I would say, at least 2050, maybe even a retest of that break. We were kind of saying last month it's there, but it's kind of hovering around that trend line. It wasn't looking healthy at that stage. I said either it breaks back into the channel and then heads up to the top of the channel again at some point, or we're going to see a proper collapse. Technicals are kind of telling us that the rand is going to get stronger. I think short-term kickback and then maybe a little bit of a stronger, because that's a new channel that's busy setting up. You might be able to join those two. You'll have a new channel, maybe a retest of 2050, and then stronger from there as well. I had my call as weaker currency for the year. That was against Verve, who actually called stronger currency. And we did a business day show where a whole lot of brokers called. Most people are expecting stronger South African rand, which will actually feed into that structured product very, very nicely if it works. Again, for me, geographic exposure, you know, the currency portion of it is, yes, you want to get a nice level on your currency, but far more important is to deploy into the right assets underneath. And if you've got nice cheap assets overseas that you're deploying into, great. If you've got nice cheap assets locally you're deploying into, that's the point. Currency, you know, it's very, very difficult to predict, but that's kind of where we see the levels. As you can see, Rand franc setting up the same kind of pattern. Yeah, again, we kind of were in that up channel. We've kind of broken into a new down channel. I would expect from here a weakness. So if I am forced to do a trade in the next week, I would be taking it pretty quickly. And then I would probably be selling up at the top of that channel, but with the view that the currency might strengthen over a little bit. So I'm going to have to kind of reverse my view from the beginning of the year, just because we are now out of that weakening channel and we're into a strengthening channel. Like I said, just looking at the technicals of currency, a lot of moving parts for the fundamentals on any currency. And our yield's still very attractive to international carry traders. So bringing DOSH into South Africa as well. We look good. We're not near Ukraine, which is also cool. So that's euro, same pattern. We had this kind of long-term trend line. We've been now kind of building like a horizontal, at least a decline resistance there. I think that you're going to go up to kind of 1720, 1715. That's kind of where you're going to see a kickback up to, and then maybe a little bit more strength as well. So I think maybe a stronger currency for the next little bit. Bring your cash back when we get to that trend line, or send it out now if you are looking at deploying and you don't want to sit for too long, not taking advantage of a sell-off overseas, which is I think a great time to go and buy into offshore stocks. So what's happening in the equity markets? Red, very red over the last month or so. Little patches of green, like Berkshire Hathaway green. We've had the consumer defensives, as they call them, looking okay. Oil obviously doing well with the kind of spike that we've seen in oil prices. As long as you're not a Russian oil company, you've done pretty good. Don't be Rosneft. But utilities also doing well. Typical defensive uncertainty stocks playing well. Aerospace and defense doing well. Like I said, Lockheed Martin up 15%. That's one of our positions. And just remember, in our portfolio, we've got we're not value or growth. We've got growth stocks, but we've always had value stocks as well. We have Johnson & Johnson, we have Pfizer, we have Lockheed Martin. I had ExxonMobil for a long time, but we dumped it just because we thought that we were a little bit behind the curve in terms of the alternative energy thing. I wish I'd kept it a little bit longer now. But yeah, hindsight is 2020. So that's kind of the position. The big guys like Google, Amazon, Microsoft are coming off the Apple. We don't own Apple, but the big traditional FANG stocks, which drag down the index. Semiconductors also under a bit of pressure, but a lot of pressure, in fact. But we'll talk about that in a second as well. But yeah, basically everywhere where we're looking, it's pretty red. Okay, if I go and have a look at volatility in general, so I'm going to have to wrap up pretty quickly now. Volatility, so I just want to put this again, this volatility spike in context. We're at about 30 on the VIX. This spike here up to about 85, that was the COVID panic. So if you think people are panicking about markets now, not yet. We are concerned, we have that extreme fear, but it's not like total blind madness fear yet, if you know what I mean. Looking at the S&P 500 again, a little bit of technicals on there. I remember we talked about joining these little dips here. We highlighted that break and said, hey guys, maybe we should be a bit careful here. And then it immediately hooked back and went back into its kind of bull run. We then said, hey, what about this one? We were looking at that and we were seeing the test there, but it broke up and we said, okay, back long equities, like that's what you got to be. Here a little bit different. We might be in for quite a protracted bear market. I mean, you join here, you can see change of trend. As soon as we get a break above that trend line, that's the signal you got to be back in the market strong, because then it's all-time highs again. But eventually we hope it will be. But yeah, kind of like setting up a bit of a bear market downtrend here. So lovely time to be buying in, 10-15% cheaper. If you want to kind of try and bottom pick, it looks like a little double bottom forming there, but not a clear-cut buy on the S&P 500 at the moment, and not particularly terrifying yet. But what's going to happen? You got to drop a nuke to get us back to 85. So I don't know. I think nibbling is the right term. Nibbling at the moment. Okay, next question. A lot of people have been asking us about Alibaba because I hold Alibaba in the portfolio and we've been getting slammed. It's a very small percentage of the overall portfolio. We risked, I think, 3% on Alibaba. It grew to about 5%. It came off again. But we properly diversified, and it's our only Chinese exposure. But as if you watched our intro to the year, which we do our big predictions, me and Viv do a joint webinar every year in January. My pick for the year was buy China, buy Tencent, buy Alibaba, buy FXI as the ETF. I was all about China, and I'm getting hammered. But it's not over till it's over. So looking at Alibaba's moves now, I mean, results are good, man. Like operationally, the business is very, very sound. Cloud up 20%. Their focus is shifting from absolute customer growth into ARPU growth, average revenue per user growth. I've put all the stuff up there. Institutionally, well covered. Everyone has this on a buy, and I'm going to show you. This is basically, we've got a new Bloomberg system, so I've got some nice Deutsche research for you. But on an analyst level, 143% predicted upside. I mean, you've got to have a dabble at this, in my opinion. We'll look at the valuation now as well. But I mean, earnings growth, you're expecting, okay, a big rebound in earnings growth now. But 2 years, 3 years out, I mean, you're looking at kind of high, high single digits to kind of, double-digit earnings growth. Revenue growth kind of sitting at 15%. So solid. You're seeing those numbers up there as well. But what's happening today, because this is Alibaba, and we're investing in China for one stock only, and we're exposed. And like I said, when I gave my Chinese thesis, I said, the Chinese economy is one in which, and the Chinese markets, it's very retail driven and it's very controlled by the state as well. Alibaba today, before this presentation, I was like, wow, this week Tencent has just been like murdered. It's absolutely been destroyed. And it's kind of, I had to say to a client yesterday, honestly, it looks like Chinese stocks are being priced as options on China seizing your capital. The ADR is being delisted in New York, and you can't have the company anymore, and we're taking all your money. That's kind of what this is pricing like, and I'll show you why in a second. I mean, Alibaba, operationally great company. The problem is the regulatory changes in China. And I said, regulation can change quickly. This is what I've been saying for a while. If China wants the stock market to go higher, China's stock market will go higher. What did we have today? Alibaba is up 25% today, by the way. China announced stocks up 25% because China has just pledged to support their stock market. They don't like their stock market getting impounded into the ground, and they don't like the fact that the US is going to delist their ADRs, and they want to be seen as an open, friendly nation, and they don't particularly want to be tied in with Russia, I don't think. That seems to be the rhetoric coming out of the party. What happens behind the scenes is maybe very, very different. But the Chinese government has announced that they are working with US authorities to try and support their listings overseas. They're saying that we're not taking a strategic position in China. Our companies do want profit like everyone else. We want to be open. We want to be Western. We want to have a market-driven economy. We're not trying to use our private sector as a military tool, which, yes, they are in a way, but yes, China wants their stock market up. They're going to support their stock market. Their stock market will go up. And when that happens, you get a 200-400% gain in Chinese stocks. So is Alibaba still worth having? Absolutely. No way I'm selling Alibaba out of the portfolio. Like I said, we've got a nice Bloomberg terminal now, so some Bloomberg stuff. Alibaba PE at the moment is 10. Compare this to Amazon sitting on a 60. I mean, in the earnings terms, it's a sixth the price of Amazon, like for the earnings that you're getting. This is dirt cheap. In a peer comparison, Deutsche Bank, which is some of the best research in the market, this is just the evaluation of risks around Alibaba. So I thought I'd put it up there. The key risks include regulatory uncertainty. We know this, fines, antitrust, kill our tech sector. That can change. They want their stock market up, Alibaba will go up. Intent of buying competition globally and locally from e-commerce platforms, absolutely. If we see this bifurcation of the world, who's going to consume Alibaba? Alibaba has always been a more China-focused business, but if you see a bifurcation, that actually opens Alibaba's markets to, their Belt and Road initiative is to kind of try and expand into more global dominance commercially. So Africa going to have access to this, maybe South America, maybe India. That increases their market significantly. So yes, more international competition is a risk, but I think that the way that the kind of shock that we're seeing now is going to feed into it. inability to integrate like basically into the existing Alibaba ecosystem. That's an operational issue, and basically the inability to expand and monetize Ali's cloud business. But cloud is up 20% in revenue terms, so I think they're going to get it right. And that's kind of the operational risks that you take with any company. The reason this company is so cheap at the moment is because, one, Shenzhen went into lockdown and people panicked around Chinese stocks. That's the kind of volatility we've seen in the last week or so. But really, it's the regulatory pressure that is being put on China by itself, essentially. And if they decide to reverse that, I think you're going to see really spectacular gains. And it does seem from the indication today that we might just be at the start of that. So let's hope it turns around. Global equity portfolio, I'm going to have to wrap up quick, but it's been a difficult couple of months for us. There's no question about that. As you can see at the bottom here, I mean, we did 20%. Okay, we had a year where we did -3, 29%, 18%, 19%. Those are the dollar-based gains after costs that we've made. We're down 12.5% this year. For me, why are we down 12.5%? Because it's stock markets that are down as aggressively as this. Are we panicking and shifting and switching and quickly trying to buy defense contractors, buying oil companies? No, that's not the style. It's not the point of this portfolio. This point of this portfolio is a long-term portfolio. I've got it at the end here. The portfolio is looking at a long-term value creation for its investors. We're trying to pick companies that are going to do well over a long period of time, and we don't have a value or growth bias. So we can do a slight tilt towards value, which is things like picking up General Motors, which, yes, it's a newer position, which is why, since inception, it's showing one of the large losses on the benchmark portfolio, down slightly as a contributor to the portfolio. Salesforce, also a tech company, more, CRM systems, etc. Also, fantastic numbers coming out of the company, but also being hit by the high inflation concerns. But we have all the kind of inflation protection kind of stocks in our portfolio as well. So you can see the kind of stocks doing well: Amgen, Lockheed Martin, Johnson & Johnson, we have Procter & Gamble, we have IBM, we have all those kind of traditional blue chip value plays in the portfolio as well. Our big three losers for this month, like I said, they're more aggressively priced ones: BlackRock, Nike, Nvidia. Nvidia is taking a bit of a thumping in the last little bit, but remember, we are still optimistic on Nvidia's future. Nvidia is a fantastic business. And while it might have been hit recently because it is kind of a little bit of a higher beta stock, it's still, out of all stocks in our portfolio, since we've been running the portfolio for 6-7 years now, it's the stock that's delivered the biggest gain for us as well. So yes, we're giving back a little bit of the gains, but we don't get shaken out of positions because Russia invades Ukraine. It's not the way that you invest longer term. If anything, as you guys can see, this is our cash distribution profile, how we implement cash into the market. We're still riding on cash, and I am deploying very, very shortly. I know it's the biggest criticism that I get, that I'm heavy on cash at the moment, but we do like to keep a little bit of powder dry to buy into opportunities like this. Like I said, we're kind of still sitting on a hand. I just want to see a little bit of more of a reversal. I have my signals of when I'm going to really deploy. Remember, we do phased implementations for clients as well. So if you are to deploy money into us, you don't get whacked. You basically get a sheet that you fill in, or at least your broker will fill in for you. It gets passed to me when we do the implementations. You either get a phased implementation or an instant implementation. I always prefer to do a phased implementation because different stocks in a model portfolio kind of move in the short term, in my mind, from sells to holds to buys all the time. If something has just spiked up 10% for no reason, I might want to get into it a little bit cheaper. Only take 3, 4, 5 months to implement a portfolio fully, and I'm trying to get you the best levels in the market. I will probably be a lot more aggressive on a new implementation now with the sell-off that we're experiencing, but you don't have to worry that if you give us cash today, we're just going to whack it into the market. It's not how it works. We're not a fund. We're a model segregated portfolio manager, which means that we can tweak things so much more finely than a fund. Our costs and our overheads also a lot lower than a fund, and all of that gets passed over to you in terms of performance. How has our performance been? Outperformed our benchmark, which is the MSCI World. Sorry, I'll show you up here. You've also got the different ones. NASDAQ is down almost 20%. They're down 17.65% as of today. Wall Street down 7%. Yeah, so 12% we're lagging a little bit. South Africa down about 4%. So, as someone just put on the group now, it's up 3.7% today. So it's difficult to take a snapshot on any of these positions because the volatility is so high. Longer term, we are nicely outperforming our benchmark, but it has been, like I said, a rocky couple of months. It's been very, very difficult. I've been very happy with my cash waiting as we kind of look to redeploy new cash. These are still great businesses, still very, very comfortable with what we're doing. And I put my own money in this. This is my best ideas on how I can buy and sell shares, and I do it in a way that I like, and you guys can join me or not. And if you don't, then we've got all these other products for you as well. So that's kind of the managed portfolio. Like I said, kind of performance for the last couple of months we've been underperforming, which has been a bit disappointing, but you can't always win. Investment philosophy, long-term, buy good quality companies, big blue chip companies that are multiple times the size of things that we get on the JSE. Sit on them, hold them, let their management teams do all the clever things that reward us as shareholders. We have all our vetting criteria as quite a quantitatively driven selection methodology. But yeah, we do kind of, it's like top down meets bottom up in the way that we think about markets. We kind of get a macro tilt on all the different geographies that we want to invest in, and then we kind of do the bottom up research through kind of what the big banks and the sell side guys and our own internal analysts, plus the quantitative overlay on top. So it's kind of, we come at a lot of different approaches. I've always felt different analytical techniques and portfolio management techniques are just all different lenses at looking at the same problem. And if you apply a whole lot of different ones, you get a much clearer picture. You get a nice 3D model of what you're looking at if you look at it from different angles. So that's how we invest, and then we just try and pick the best companies we can for you. Minimum investment $50,000 dollars, that is. Overseas, I can't really go smaller than that. Because it's a segregated portfolio, it's one of the drawbacks, but as not having this as a unitized fund, it is suited to slightly bigger investors. But yeah, massive transparency. You see everything that happens inside the portfolio, unlike a fund. When I buy and sell, you see it. When you can literally go and look at exactly how your portfolio is structured. You don't get that level of transparency with a unitized fund. But that's because that's why we're stockbrokers, because we can do things that other people can't. Like I said, if to deploy into it, I don't think 1510 is a bad level. Maybe longer term, you might see our currency getting a little bit stronger, but overall, I think good. All we need to do, go to ranswers.com/account, hit the button, hit buy, send us your FICA documents, and fund your account, and we take care of the rest. Obviously portfolios above $1 million, we give private broking service to normally, depending on what you want. We can also cut your costs and be a little bit less engaging with you, give you lower fees. Private broking, it's all based on the relationship that we build with you. Smaller accounts, obviously, kind of a little bit, has to be run a little bit more mechanistically. But overall, guys, I suppose the message that I want to give you today is like, markets are wild at the moment. Be careful out there if you're trading yourself. If you need help, that's what we're here for. Just appreciate as well that, things have gone absolutely berserk. So we are working incredibly hard to make sure things, one, the business keeps building and you get better and better service and better products and all the good stuff that we've got to do in terms of research and customer service. But we are really here to serve you. So, we put all our flow together and we're trying to make something really, really special for you. And hopefully that's what you're experiencing. If you're not experiencing it, please do let us know if you have concerns, because any issues that we're facing, no one's perfect, and we're going to make mistakes, but we want to fix them as well. So if you do have any challenges, please come and talk to us to keep the lines of communication open. We're still in this kind of weird COVID world, but at least we could be getting back to physical presentations at the JSE soon. Our offices are finally done. The JSE's renovations are ending, so we can start hopefully doing these in person and shaking hands and seeing our clients the way that we used to before the COVID-19 pandemic. But thank you everyone for attending. I'm just going to run through questions really quick. Crypto we've talked about. Are we heading into a recession in 18 months' time? I believe yes, we are from an economic point of view. If stocks stay low, then yes, probably. Oil prices where they are, I think global recession is a real possibility. Stock markets are a fantastic predictor of economic activity. A recession is an economic thing. It's not a market thing. It's 2 quarters of consecutive negative growth. And I think a recession is very likely. Does that mean the stock markets are going to do badly from here? No, stock markets at the moment for me are pricing in a recession. And if we don't have a recession, stocks are going a lot higher. so yes, how would you benefit from the Russian stock market? What sectors and industries would you research? Russian stock markets at the moment, sanctions kind of making it impossible. All our product providers and liquidity providers have put Russian stocks, which we gave you access to on, you can still have the stocks that you have, but they're on reduce only at the moment. You can't buy new Russian stocks on the systems, and it's because of the massive financial pushback from governments and regulations. So we can't really give it to you. The way that you can do it is, of course, indirectly, like you can always do, because a stock is just a basket of economic activity running underneath it. So a nice play, and I think if you want to play a recovery on Russia, which I think just be careful of, I mean, I think Russia's going to be in trouble for a while. You might look at something like Mondi, about 1/5 of their revenue, 1/5 of their profit comes from Russia. They are looking at separating out their Russian businesses legally, though, so that they won't be part of Mondi anymore. But if you buy before that, you'll still be a shareholder in those Russian businesses. They can't seize your assets. They have like a paper bag factory, a brown paper bag factory in the Ukraine, and then they've got, I think it's about 1,000 kilometers from Moscow. They've got a pulp and packaging factory as well. It's a really weird situation at Mondi where their updates have been very good to the market, and they kind of have talked about just the operational challenges that they're facing in Russia, which is insane. They can't get spare parts. The plant that they run is also doubles as providing heating for the surrounding community. It cleans the waste water from the plant as well, and supplies drinking water as part of the plant's kind of integrated operations. And they can't get replacement spares. They've just been shut out of the global environment, and people are going to freeze and die. It's scary. Like, I mean, you think economic sanctions aren't as hectic as dropping shells on people in the Ukraine. They can be. People that have nothing to do with Vladimir Putin and the elites in Russia. Russian people are also going to suffer incredibly because of this. And it's an ugly situation. I'm sorry, I don't want to get too emotionally involved in this, but yeah. Cool. US China are at current war stealing US property. Yeah, I mean, China US tension has always been there. Biden administration is a lot more friendly towards China than the Trump administration was, though. So let's see how that works out. Yeah, I would like to see like I mean, you know me, I'm an optimist, and I like optimist and economist. So you know, the benefits for mankind through an increase in global trade, people working together create amazing things. They put people into space, and they put cell phones on our desks that can communicate with our family anywhere in the world. They make jets that can deliver me anywhere in the world. I mean, it's amazing what humans can do when we work together, but you know, it's amazing how much destruction there is when we work against each other. So I hope the US and China manage to come to some sort of more productive relationship, put it that way. International trade and the barriers that we've been seeing thrown up in international trade in the last 10 years are going to have a material impact on global productivity and the quality of life of everyone. You know, reducing trade and seeing ourselves as one nation globally, one people, one human race, we'll see massive economic benefits instead of this very crazy factional infighting. You know, nationalism is evil, man. There's no question about that. Cool. And on that note, there's a couple more. How would you protect your wealth in these uncertain times? And I think we covered most of that during the presentation. Buy stocks, man. Don't hold cash. That's all I can say is do not hold cash. And if it's, if you've got a long-term view stocks, if you've got a 2 to 5 year view, put capital protection on it. Look at bond-based products. Look at the correct asset class for the correct task. Use the right tool to build the right product, to build the right type of portfolio. And if you in less than a year, you should be in cash products, even though they're going to hurt. But South African cash doesn't seem so bad at the moment, especially if we are going to get a stronger currency, and we're getting really, really nice yields at the moment on our kind of cash deposits. So, and that's only going to get better if interest rates keep going up. Also up to, do you think the correction is over, or do you see a decent, this broken market needs a decent correction? Listen, I don't, Roloff, I don't disagree with that. I think a proper correction in markets now, I've been saying for a long time that I think that there's, I mean, what the central banks have been doing, like there are serious allocated inefficiencies and distortions in free markets. But again, I'm an anarcho-capitalist. Less government, less government intervention, the better. Leave people to do what people need to do. Give us the freedom to build and deregulate. That's always been my thing. So. Yes, the kind of things that we're seeing, I think we're heading in the wrong direction personally. And I think the chickens are going to come home to roost eventually. But is this the time? Maybe not. Longer term, let's hope we work things out. Cool. And on that note, thank you everyone for coming. As always, I've run over time, but I really hope you enjoyed the presentation. If you have any questions, you can hit us up on email. And if you do want to become a client, which you should, because we're a good bunch of people, send an email to info@randswiss.com. Thanks, everyone. Hope to see you again next month.